Okay, team number 1, where are you? Let's start again. Team number? Okay, only 1.
3,
Okay, there we go.
4,
5,
Come on.
6,
7,
8,
9,
10, 11, 12.
3 gets 1 point. That was the previous. Okay. Okay, cool. Now, hey, what is this? I don't know. Okay, so here, I want you to pay attention to the class webpage, right? I uploaded some important materials for you, and I can check out how many people watched it. And what do you see over here? Last year's midterm exam. I uploaded it. And only 16 people watched it. I can see that you're not interested in finance, which is disappointing to me. You have to watch it, okay? Why did I upload this one? Because it's going to help you prepare for midterm exam, okay? Your textbook, the book chapter problems, they are way more advanced, okay, than your level right now. I told you before, it's more for preparation for fall semester's more advanced class. In any case, you will need it if you major in finance, but at this stage, it is more advanced than necessary. So, last year's midterm questions, go ahead and read it and try it yourself. Your answers will be there, okay? If you have any questions, I don't understand this terminology or that terminology, ask me openly in the classroom during the class session. Next class or next week, you have 3 classes before midterm exam, okay? Anytime, just hold me and say, what do you mean by this, okay? I will answer those questions, we will share it, okay? And that means my midterm exams, I usually create my own midterm every time, and final exam as well, okay? Current issues, right? We have a lot of interesting current issues. It's going to be fun as well. Last year's midterm questions, what was it? If you look at it, opens it, and then there comes what? Cat, Korean Air. Is it in current issues as well? Yesterday and today, right? Non-trivial issues, okay? All these things. It's gonna be fun. I hope you enjoy it. Group 2, what was that? Group homework for participation grade is also available for you, okay? So go ahead and read it and try it until next week. Team number 5. We have unfortunately just 1 person over here. 2 persons disappeared and they don't show up. So any 3-member or 4 members group, please raise your hand. I have only 4 members in our team. 1, 2, 3, 4. So I will run a random number and then allocate these 3 persons to some of you, okay? Just like the same way as I did for previous ones, okay? So I hope that's going to be okay for you guys. Anyway, now, yes, and then how about the lecture note for corporate governance? It is going to be in your exam as well, okay? Your exam strategy, number 1, last year's midterm exam questions. Number 2, class notes, right? Class notes. Oh, the true study. it is coming when true knowledge comes from the book. So I'm going to go through all these book pages and then cover to cover. No, that's an easy way to screw up your life. And infinitely many ways of screwing up your life. It's up to you. But my suggestion is class note first. Okay? And one of those class notes is corporate governance. It's going to come and bother you like crazy. And notes also have their own practice problems there. Go ahead and do it. Okay? I got excess amount of time. I don't know what to do. Fine, do some other works, right? So that's it. And then news articles, I suggested over there. 3-month CSR, we did not cover it yet, but it's self-explanatory. Okay? Is CSR a symptom of agency problem or something value-adding? It's a huge debate going on there, and it's worth thinking about it. Anyway, so today we are going to go through lecture note 3, okay? And you see my RA, Sijia, right? Chao Sijia. She's my best RA, by the way, in the master's degree, and she kindly takes the video of my lecture today, okay? Why? Because some of you said I got bad flu type B or something. So I will come to the classroom and then watch you over there somehow. And I was afraid that it will affect every one of you. So I said, don't come, right? Stay home. I'm going to videotape those things and then we can share it on YouTube. Okay? We will do it. I will do it. And so she came over here. So give her a round of applause. Thank you. Take the best picture of me. Thank you. Now, lecture note 3, right? So, okay. Yes. Okay. So, Ed, where did last class? We've been going through this discount rate, okay? And the starting point of this discount rate or required rate of return is risk-free rate, okay? The idea is, well, I want to get compensated at least as much as risk-free rate is giving me or those treasury rate is giving me, okay? Your stock, your investment opportunity is risky, so I want some more premium, okay, compared to this benchmark risk-free rate. Now, risk-free rate, if your country is AAA country, no problem, your treasury rate equals true risk-free rate. On the other hand, if your country is non-AAA countries, like Korea, AA, Japan, single A, right? Then you have to know that your treasury rate of the government is not true risk-free rate, but there is some default spread added onto it, your true risk-free rate. So to get to that ideal conceptual risk-free rate, we had to subtract the default spread from the treasury bond rate, right? Now, risk-free rate when valuing real currency, the real currency, real rate, right? The most popular benchmark is US TIPS rate, Treasury Inflation Protection Security, assuming that the capital market in the world is frictionless and there's no transaction cost. When capital money moves from one country to another country to still another country, if there's no transaction cost and you can move freely, then the real risk-free rate should be the same all across the globe. That's the idea. If any country offers higher real risk-free rate, then money will move from one country to that country in real time, as long as there is no friction in the market no transaction cost, no barriers, right? But in reality, we have a lot of barriers, right? FX market is there to eliminate, try to minimize those costs, but we still have those frictions in the market. Anyway, this is a strong assumption, okay? Real risk-free rate should be equal to long-term real GDP growth rate in that country, because the government can promise to pay interest as much as the long-term GDP growth rate. Now, sometimes your country does not provide, you cannot have find out true risk-free rate of your country, which is not AAA. Sometimes you can use this interest rate parity concept. If you can find out some AAA country's currency, right, and your currency is here, and here's a timeline, okay, of those two currencies. The idea about interest rate parity is this. Starting from one currency, let's say here, Thai baht example, and then the other currency is Singapore dollar, SGD, okay? AAA country versus non-AAA country. We know the true risk-free rate of Singapore dollars by looking at their treasury rate, but Thai baht, we don't have it. How can we infer? Okay, how can we infer? Using foreign exchange spot market and then foreign exchange forward market. Spot foreign exchange is easy, right? Just changing currency today. Forward is a contract or promise between two parties, right? For example, 10 years down the road, okay, 10 years later, the Thai baht currency will be converted into Sing dollars at this rate, 61.36 Thai baht per Sing dollar, whereas right now it is 38.1 Thai baht per Sing dollar. Okay? So this is a promise, right? That you will make this transaction 10 years later. Okay? It's a contract, forward contract. So if this contract is there, why don't we use it? Okay? This idea. Starting from here, Thai baht currency, you convert it into Sing dollars and keep it at Singapore risk-free rate. You will arrive over here. Make sense? That's one path. And you can think about the other path, which is keep your Thai baht at some risk-free rate if there should be anything, if there should be some true risk-free Thai baht rate. Keep that money 10 years and then convert it into Sing dollars at the promised rate of forward currency rate, 61.6, 36, right? So whether you go this direction or that direction, you have to end up in the same destination. Make sense? Right, that's the idea. Okay? So, first path is like convert your Thai baht into Sing dollars, which is 38.1, and then keep it at Sing dollars risk-free rate, 10 years. Should be equal to keeping your money at Thai baht true risk-free rate, which is not observable right now, and keep it 10 years, okay, 10 years. And then later on, you convert all those Thai baht into Sing dollars at promised rate, like this. They should be equal. Make sense? The only unknown is this guy, right? True risk-free rate in Thai baht. Is this the treasury rate of Thailand? And the answer is yes or no. No. This is true risk-free rate that we are trying to get at. Thai treasury rate is something observable, and that is non-AAA country. Make sense? So that's why that Thai treasury rate is not really the true risk-free rate. So that's why we are doing all this trouble. Now solve this for Thai baht risk-free rate, and you will get this point. Okay, if you do the math, right? This guy is this one, and send this guy to the other side of the equation. So this guy goes to the numerator over here. Make sense? So that's how we solve the problem. That's one way of solving for true risk-free rate in non-AAA countries. Okay. The next one, I refresh your memories about Fisher equation, and it has to do with your inflation and interest rate, and nominal rate and real rate. The idea is that your nominal interest rate plus 1 should be equal to 1 plus real risk-free rate times 1 plus inflation rate in your country. And if you do the math, you will see this kind of expansion. And then, just for your notation purpose, Rn in the country says nominal interest rate in that country. Rr is real interest rate in that country. And I, a big I, that country means inflation rate of that country. And this is expected inflation rate. Okay, expected inflation rate. Let's put some numbers here. For example, real interest rate of US 0.53% and inflation rate being 2%, then we can compute nominal interest rate of the US, right? Doing that math. And because this guy, the last term, will be very minimal, we usually ignore this part, but that's it. Okay, like this. We're going to use this Fisher equation 1 slide or 2 slides later. Let's see. In getting those risk-free rates. Okay. If you assume frictionless capital market all around the world, right? The real risk-free rate has to be the same. Okay. We use that idea to get the risk-free rate of non-AAA countries. Okay. Here, the example is Vietnam. Assuming frictionless perfect capital market where money can move freely from one country to another, let's say from the US to Vietnam, and we want to know the nominal risk-free rate of Vietnam. Okay? Based on nominal risk-free rate of the US and Vietnam, and on the expected inflation rate of the US and Vietnam, we can use Fisher equation and flip it. So US nominal rate should be real risk-free rate plus 1 times inflation rate plus 1. There, we want to focus on this real risk-free rate. Why? Because we want to equate this guy with the real risk-free rate of Vietnam. They will be the same under our assumption. And then the unknown we can solve is the nominal risk-free rate of Vietnam. So, let's go. Real risk-free rate of these two countries equals nominal rate divided by 1 plus nominal rate divided by 1 plus inflation rate. The same thing for Vietnam. Notice that these two guys will be identical, or wait, US has to be here, not V. Okay, just to make sure you are not sleeping. Okay, you have to cross out V. US has to be there. And assuming frictionless capital market, then you can see that these two guys will be equal, right? So we can solve for nominal rate of Vietnam, or this guy here, and send this guy to the other side of the equation by multiplying it. Okay? Now we have what? If you do the math, you will realize that Vietnamese risk-free rate plus 1 is US risk-free rate plus 1 times 1 plus inflation rate of Vietnam divided by 1 plus inflation rate of the US. So, the nominal risk-free rate of Vietnam will be this ugly term minus 1. And the second term over here is what we call differential inflation between the US and Vietnam. Alright? Now, risk-free rate if you don't have or if you don't trust the government bond rate, we have two different approaches that I explained, right? One is build-up approach. The risk-free rate in any currency can be written as a sum of two variables using Fisher equation. The other is US dollar rate and differential inflation approach, which is alternatively you can scale up the US risk-free rate by the differential inflation between the US dollar and the currency in question. So it works like that. Identical formula as the slide before. Now, here's an example. If the US risk-free rate is 2% and the inflation rate in the foreign currency is 15%, and the inflation rate in the US is 1.5%, then the foreign currency risk-free rate will be as follows, which is 1 plus 2% times differential inflation rate, which is 1 plus the currency as inflation rate divided by 1 plus US inflation rate, and then you will be able to find that the risk-free rate of that currency will be 15.57%. Here's one question. You are doing business in Myanmar and you need to estimate the value of a company called Sweatong Group, one of the largest conglomerates of Myanmar. And then Myanmar's true risk-free rate is not available. Now you are in trouble. So estimate it with the following information. And US dollar risk-free rate is 2.5%. Inflation rate in the Myanmar is 6%, and the inflation rate in the US is 1.5%. So your answer is what? Your answer is this, 7.044%. Why 1 plus 2.5% US rate, okay, times the differential inflation rate between Myanmar and US. Okay, 6%, 1.5%. So it becomes 7.044% because we are subtracting 1 over. Questions? Right? Doing business in Myanmar, okay? There's a big corporation in Myanmar established by one Korean people there. They're doing good business in transportation or something. Anyway, so why do risk-free rates vary across currencies? The graph over here shows what? The default spread and then risk-free rate. So the treasury rate for each different countries, and subtracting those default spread, you get the true risk-free rate of each different countries. Okay? Then if you look at these green bars, why do countries have different true risk-free rate? Primarily because of different inflation rate going on in that economy. Okay? So that's the idea. Now, if you have any questions, please. Doable? Okay. Now we can move on to the next class note, which is over here. That's note 4. Yes. Open it. Then, yeah. Now, this is going to be about equity risk premium. We are on the way of getting at the cost of equity. The first starting point of getting cost of equity was risk-free rate, and then the next step is about obtaining equity risk premium, and then we'll move on to the concept of beta. Okay? And then once we learn about the cost of equity, we're going to learn about cost of debt. Essentially, we're refreshing our memories. And then we'll refresh our memories about weighted average cost of capital. Okay? Midterm exam, I think, is going to start around here. Around here or there. Okay, but let's see. The discount rate model, we get back to the same picture time and time again. Basic concept is start from your risk-free benchmark and then add some risk premium. How do we construct this risk premium is primary question. We first delve into capital asset pricing model. We're going to talk about market risk premium and then something called beta, which turns out to be risk premium part. Okay? Either you call it market risk premium or equity risk premium, it's the same thing. And then that's our grandpa model of risk and return. And then whether you call it CAPM or CAPM or capital asset pricing model, that's this guy. And then people moved on and then came up with some more sophisticated model like pharma French 3-factor, 4-factor, 5-factor models, hedge funds. They come up with 10-factor models or n-factor models. All they are trying to do is capturing this risk premium. Grandpa models, CAPM or CAPM, we worked with just one factor, but people are trying to become more sophisticated. If you heard about something called quant investors, right? They are doing that kind of job. In your semester right now, we're going to focus on this guy. CAPM is troublesome enough for you. Don't worry. Okay? Risk and return trade-off, it's a concept we have to go through first, right? Now, because we are talking about this premium about the risk. The risk concept of this, right? In traditional terms, people view it as more negative or something dangerous that you have to always avoid. Oh, I'm risk averse, I hate it. Okay? But in Chinese symbols for risk, okay, seems like they sometimes call it this. How do you pronounce this thing? Thank you, 위기. Or in Chinese, 危机, right? And then this is a combination of two words, vocabo kind of thing. 합성어? So what is it? 危险, is that right? 危险. And then 机会, right? So 위험 plus 기회. So 위험 is danger, right? And then 기회 means what? Opportunity. So risk says that your opportunity comes in disguise of, in the face of danger. One prominent example is Warren Buffett in 2009. In that financial crisis period, all the banking stocks like Goldman Sachs, Merrill Lynch, Citibank, Bank of America, JP Morgan Chase, you name it. Those guys' stock price used to be around like $60 per share to $160 around per share. But in 2008 and 9 crisis, like 10 years ago, all of a sudden their price crashed down to like $5 per share, or $3 or $2, close to bankruptcy. Okay? Literally, me, including myself, everybody felt like this is the end of the world. We call it panic. Okay? This is the Armageddon. There's no tomorrow. Everybody sold it, right? But Warren Buffett, okay, and came back over there and said, wait a minute, it seems like people are, overly selling these stocks. As I look at this intrinsic value of Goldman Sachs, I think it's worth much more than just $5. So I'll put, what, $2 billion or something into Goldman Sachs. And then guess what? The stock price later on, within 1 year, it jumped back to like $50 or something within that. So the opportunity really came in the face of danger in that sense. So if you have those solid valuation technique in you, okay, then the risk will be your friend. Okay, that's the concept over here. Okay? So risk is neither good nor bad. It's just a fact of life. The question is that businesses have to address is therefore not whether to avoid risk totally, but how to manage this one and how to quantify it. Quantify into our return. Remember, risk is different from return. But how can we translate this risk into return? Okay, that's this thing. Okay. The notion of benchmark. Since financial resources are finite, there is a hurdle that projects have to cross before being deemed acceptable. This hurdle rate should be higher for riskier projects and lower for safer projects. Okay. A simple representation of the hurdle rate is as below. As usual, risk-less rate plus risk premium. Two basic questions that every risk and return model in finance tries to answer are how to measure risk and how to translate the risk measure into risk premium. So a good risk and return model has to have 5 elements in there. One, it should come up with a measure of risk that applies to all assets. Okay? If your model applies only to stocks and doesn't work for real estate, you're in trouble. Okay? It should clearly describe what types of risks are rewarded and what types are not rewarded. Okay? Not all risks are rewarded. Okay? You will refresh your memory about that. Okay? Some risk, you take it and you screw yourself. Some risk, you take it and get rewarded somehow. Okay? You can ask for more discount for that one. Okay? Number 3, it should come up with standardized risk measures. We're going to play with something called beta, standardized measure of risk. An investor presented with a risk measure of an individual asset should be able to draw a conclusion about whether the asset is above or below average risk level, based on that standardized risk measure. Number 4, it should translate the measure of risk into a rate of return that the investor should demand as a compensation for the bearing risk. And number 5, it should work well not only at explaining past returns, but also explaining expected returns in the future. Okay? In predicting future returns. Now, capital asset pricing model is the one we're going to work with. And it has these 5 characters well suited. Okay? Criteria satisfied. It uses variance of actual returns around an expected return as a measure of risk. We call it mean variance word. Okay? Variance is the variance of the returns, right? Stock returns or asset return, price returns. And then expected return of it. Okay? You want more risk, more return, but less risk, right? So there should be some trade-off, and this concept of CAPM nicely works out that time. Number 2, it specifies that a portion of variance can be diversified away, and that is only the non-diversifiable portion that is rewarded. And number 3, it says it measures the non-diversifiable risk with beta, which is standardized around 1. We're going to get to this idea later on. Number 4, it translates beta into expected return with this formula like this. Expected return will be equal to risk-free rate plus beta times risk premium. Equity risk premium or market risk premium, you call it, okay? Number 5, it works as well as the next best alternative in most cases. So it nicely works throughout, a lot of different asset classes. Now, mean variance framework. The picture I show you over here is this. All assets, right? Stocks and bonds or oil, right? Or commodities. Those assets or real estate. We have some expected return for every risky asset, right? That's something like mean concept in our statistical analysis, right? Mean, if you remember, normal distribution or bell curve, that kind of things, right? We can think about a histogram of returns, looking back in history, the realized returns, Sometimes we have good returns, sometimes we have bad returns, we have dispersions, right? But usually it hovers around the average value, and then that's when we look back in history, okay? Of course, our purpose is to have some prediction about the future, but the past history is the best predictor for us right now. We have limitation over there. Now, around the expected return, we'll have some dispersion of realized returns. Some stocks or some investments will have high standard deviation of return. Some investments will have smaller standard deviation of returns. Okay? Will they have the same expected return? No, I'm not saying that. Some stocks will have lower, some stocks will have higher expected returns. But what I'm focusing on right now is the dispersion, the standard deviation, or the variance part of the return. Okay? Total risk is represented as the standard deviation of return. So this measures our total risk. Total risk. Some stocks have higher total risk, some stocks have lower total risk. So let's see the risk and return of the following three cases. One is Celltrion, a biotech company in Korea. Market cap-wise, the largest one in biotech in Korea. Number two is what? LG Chem, petrochemical company, right? And then the third case will be 50-50 portfolio of these two stocks. Now, Celltrion's return chart shows like this, okay? It's a daily return that I show you, so it's very much spiky day by day by day by day. And I want you to note this scale over here, plus and minus 20% up and down, right? Keep an eye on this. And over the same period, this is LG Chem. I want you to pay attention to this one and over here. It's not 20%, it's 10%, right? So that's not in the same scale. So let's put it into perspective so that two stocks are contrasted in the same scale, right? Different color. So which one, okay, in total risk sense, which one is more risky? Celltrion, obviously, right? LG Chem is just like ExxonMobil kind of guys in Korea. Petrochemical, you need it, right? You need it. Nowadays, LG Chem produces what? Batteries for electric car. Tesla, if you drive Tesla, you need LG Chem. Or Panasonic, I don't know. So, they are safer business, right? Biotech company more risky. We can see that in the picture. And we can draw a histogram, plot a histogram of Celltrion's return, realized return, okay? Over here. You see, on average, day by day, Celltrion was making 22 basis points up over the sample period, okay? Sounds good, but their standard deviation of daily return is what? 3.16%. Can you imagine that? 3% up or down swing is no surprise. 67% of your time, you will face 3% up and down swing. Okay? Lose money and win money. Huge risk. Let's see LG Chem. Our unfortunate LG Chem, the average realized return turned out to be 0. Okay? Dun, dun. So we call it dun, dun. And then the standard deviation is only 2%. Okay? So you see a lot tighter distribution, right? Smaller standard deviation. You can clearly see it. Now, which company is riskier? Yeah, obvious. Well, which company has bigger expected return? Obvious, right? Celltrion. Question 3, if you create a portfolio of these two stocks, 50% of your money in Celltrion and the other in LG Chem, what would be its expected return and risk like? Expected return and then standard deviation. And here we see it, 50-50% Seption and LG-Chem. We see that average daily return over the sample period is 11 basis points, positive, 0.11% positive, happy, right? Better than having put all the money in LG Chem. How about the risk, total risk of this portfolio, the standard deviation of this portfolio return? Shouldn't it be higher than 2%? Because LG Chem had about 2% standard deviation. Now we are mixing LG Chem with riskier stock, right? Celltrion. So shouldn't we have higher standard deviation than LG Chem's 2% standard deviation? The answer is no. Here we have lower standard deviation. If you compare this 1.95% with this guy, 2% over here, slightly lower standard deviation, slightly lower risk, but much better return. Make sense? So it's much more efficient in a sense, because you avoid more risk but achieve better expected return. Isn't it efficient, right? Why do we have that? Because it's correlation issue. Okay? Data guide, I want you to download those things in your computer. This is stock price data, return data, as well as accounting data about Korean companies, right? I'm not going to do it over here because our poor computer does not work properly with data guide yet. I want you to install it on your Excel as an add-in function. Besides, you have what? The group homework 2. There you are supposed to download from Words the crisp data of the US companies, the same companies that you worked before. Previously, you downloaded accounting data, right? This time, I force you to download the stock return data and then work this thing out. Find out the correlation between two companies. I give you some pairs over there. Google and Facebook, ExxonMobil and Chevron, right? Do they move together or not? How does it show up in correlation? And then Excel spreadsheet, you use correl function, correlation, okay? I hope you enjoyed that part. Now, discussion about marginal investors, we have to do it, okay? As we go into risk and return concept, we have to talk about marginal investors, something called marginal investors. Risk is related to return, and realized return is computed using this price, right? Today's price and the initial purchase price. Your return that we are concerned about is determined by this price. And the question becomes like, then who sets the price? Okay? In Economics 101, in perfect competition market, are we the price setters? And the answer is no, we are just price takers. We are price takers, and capital market as well. You and me, okay, individual investors, usually we are not the price setters. We are price takers. Whatever the price is determined in the market, in equilibrium, we take it and then trade on it. Who sets the price? Okay? That is the concept of marginal investors. Okay? At the margin, marginal investors, that concept has nothing to do with whether you buy and sell the stock on borrowed money. Margin trade, margin transaction, no, it has nothing to do with the concept of marginal investors over here. Okay? We need to take the perspective of the investors to set the price. That's marginal investors. So, how are they determining the price? So, here is one conceptual case that I can throw you. Here's Hyundai Motors, our good old friend Hyundai Motors stock, okay? And I want to buy this stock and compete by competing with KIC, Korea Investment Corporation. What is that? That is by far the best 금융공기업 in the whole Korea. Okay, I think 갑종갑, we say ultimate 갑, which is like ultimate buyer. You can think about it as like Fidelity, kind of, biggest pension fund or something. This is not a pension fund, but whatever Korean treasury is left with, like excess money they got, right? They don't know what to do. So 한국투자공사, like KIC, gets their money and then invest in different stocks. So these guys have billions and billions of dollars in their pocket and then invest in thousands of different stocks, not just within Korea, but outside Korea as well. They go to America sometimes, they go to Brazil and they invest in some of the international stocks as well. Now, Andy Kim as an individual investor and KIC, oh my god, the Goliath, right? We are in the competing bid for Hyundai Motors stock, okay? And how much would I call the price? My bidding price will be a function of the information about Hyundai Motors cash flow and its growth and my perceived risk of the Hyundai Motors, right? Risk or discount rate that I charge to Hyundai Motors. How about KIC? How much price can they bid up? Well, they can bid up as much as their information about cash flows and its growth rate assumption and their discount rate assumption. How much risk do they perceive for the same company, Hyundai Motors? Okay? Now, let's assume both of us have the same information about the cash flow and its growth rate and its scenarios. Everything is the same. Andy, aren't you stupid than KIC? I know. The guys in the market are smarter than me, but let's assume we are the same. We have the same information, same model to use. The only difference that we have is the discount rate about Hyundai Motors. Okay? So, whoever bids up higher price will win and buy it and set the price. Okay? Who will win? Who will have higher valuation number is the question, usually. And that boils down to who has lower discount rate for the same company. Yeah, for the same company, shouldn't you charge the same discount rate? But that depends on whether you are diversified or not. Okay? Diversification of a portfolio. The graph over here shows portfolio's total risk. Okay? On the vertical axis, this is a portfolio's total risk, standard deviation of my portfolio return. Okay? On the horizontal axis, I show you a case of one stock portfolio where I put all my money into one stock. I don't know what that kind of, I forgot the name of that stock that I put over here as an example. One tech company, I think. And then it says that 35% volatility, right? Risk is what you can get if I put all my money into one stock in that example. Second bar is when I split my money into half and half to another stock. Third case is when I split it to 3 different stocks equally. Okay? What are the components? It doesn't matter. Okay? But the important thing is as I diversify my portfolio, the total risk of my portfolio gets diminished. Right? Gets diminished. Oh yeah, that's fun, right? Let's go down the road. But does that go to 0 absolutely? And the answer is no. There's some part that it just does not disappear. Okay? That's something called systematic risk. Okay? when the macroeconomy gets hit, all your portfolio gets hit together. You're going to toilet altogether somehow. It's just a matter of who goes to diarrhea, who suffers from constipation a little bit, right? Sorry for being dirty, but yeah, it's a matter of sensitivity within your stock. Everybody goes to the toilet together. Now, this part is something called diversifiable risk, or idiosyncratic risk, or unsystematic risk, or firm-specific risk, or unique risk, or you name it. Okay? I told you, finance, we are living in a very dull world, so we have to come up with a new jargon to scare you off, which means all the same thing. Diversifiable, KIC guys, right? If you're well-diversified portfolio managers, your CEOs doing crazy things, I don't care. Because if Hyundai Motor CEOs or Hotel Sheila CEOs do some crazy things like, whatever, its competitors will be performing better so that they will cancel each other out somehow, right? Bad news for one company, maybe good news for other companies. Number two, well, I have 2,000 different stocks in my portfolio, and Hyundai Motors is just one of them, one of thousands, right? Who cares, right? So it disappears, okay? But for me, poor Andy, all my money put into Hyundai Motors. This, I get exposed to not only the systematic part of the risk, but also company-specific risk. I'm so much afraid that if 정몽구 goes like crazy, so 의선이 형, like, I don't know, I will be afraid of all kinds of firm-specific risk. Okay. Now, with that idea, come back over here, right? KIC and me bidding up for Hyundai Motors, right? That depends on the discount rate that we charge, right? KIC for KIC, Hyundai Motors is just a small piece, right? All they care about is, does this Hyundai Motor make my market portfolio riskier and more dangerous or not? Okay? To the extent that Hyundai Motors makes my portfolio risky, I'm going to punish it and discount more. But if not, who cares? For me, not only that systematic risk matters, but also 정몽구 risk was huge to me. So that my discount rate for Hyundai Motors will be always bigger than KIC's discount rate for Hyundai Motors, right? Given that, who will have bigger valuation estimate for the same company? KIC, because their denominator is smaller, right? With the same information, same valuation model, they always come up with better valuation, higher valuation than me as a rational response, right? And they will always set the price. They are usually the price setters, and they are the marginal investors for publicly traded companies. Okay? If your stock is publicly traded in the stock market, right? The marginal investors will be this kind of well-diversified portfolio managers. Now, if you take a step back, what about privately held company? If your stock is not traded in the market, right? Your company is a private one, then your marginal investors will not be diversified portfolio managers. KIC may not know about your company. Oh, I manage my coffee shop somehow, but it's not listed in the stock market. Well, KIC will not even know that your company exists. They would not put their money, okay? Maybe your mom and daddy and yourself are placing all your wealth into that coffee shop. You are exposed to the total risk of your company. Okay? So the discount rate in that framework will be different, okay, from what we talk about over here. CAPM and all these things are usually assuming this traded stocks and then assuming these marginal investors being well diversified portfolio managers. Private companies, your marginal investors are different. Okay, we're going to get back to that idea later. If adding HMC to my market portfolio makes my market portfolio riskier, I will not invest in HMC. This diagram shows the explanation that I said before. Okay, very self-explanatory. And then why diversification reduces and eliminates firm-specific risk. Well, firm-specific risk can be reduced, if not eliminated, by increasing the number of investments in your portfolio. Market risk cannot. When the macro shock attacks the whole market, you cannot get away from it. Okay, macro shock. The analysts and the fund managers always complain about it, right? Oh, my investment strategy was very smart, but unfortunately we were hit by macro shock. Going toilet together. Okay. Right. And then portfolio formation with two different stocks. Okay, I show you with Apple and ExxonMobil over here. So on the horizontal axis we have standard deviation of your portfolio return. So total risk of your portfolio. On your vertical axis we have expected return of your portfolio. Okay, each dot on that chart will be each different portfolio that you can conceive. Right? Here you have ExxonMobil, and then there you have Apple. Right? Now, if you look at their total risk, this one portfolio, 100% your money is in ExxonMobil. Over here, all your money in Apple. I love Apple so much, and then everything goes there. Okay? Risk, high risk, return, high return. Okay? You can roughly see that. Okay? Now, the red line over here, okay, are all possible portfolios, risk and return, composed of only these two stocks. Half and half, more on Exxon, more on Apple side, right? Assuming these stocks are infinitely divisible, right? Proportionately, right? And you see interesting pattern over here, okay? Why doesn't it line up in this straight line? That's because these two stocks are not perfectly correlated. If they are perfectly correlated, they will line up over here. On the other hand, if they are perfectly negatively correlated, they will line up like this. At some point, you will have risk-free return. Okay? Whenever there is bad thing happening with this company, good thing happens over there. Exactly canceling each other out. Okay? Now, if these two stocks are not correlated, zero, the line will be over here, conceptually. And this one, realistically, based on the historical data, I found the correlation to be 0.21. Okay? And even more interesting thing is this part over here. Okay? You see the risk level of Exxon 23% around. And then if you form some portfolio like this area, okay, you can achieve better expected return with smaller total risk of your portfolio. So that's what we call efficiency. Lower risk, better return. Okay? And then if you consider three different stocks, okay, can we try it? Okay? I tried it with Celltrion, Hynix, and LG Chemical, our good old friends, right? Before we move on further, you see standard deviation and mean return, historical basis, right? And then if you plot it on this standard deviation and then expected return chart, right? Celtrion goes up over here, high risk, high return stock. And our poor LG Chemical, 0 return, if not negative, right? And still some risk over there, okay? How about Hynix over here, right? Now, 100% in LG Chem, that's one portfolio. 100% in Hynix, that's this portfolio. 100% in Celtrion, this portfolio. Then, if we assign some random weight for these 3 different stocks, right? Weight sums up to be 1, and then 1,000 different stocks I tried, and there were those 1,000 different combinations, right? Those portfolios will start up over here, okay, like this. And again, you see some efficiency you can achieve over here, right? Compared to LG Chem, these portfolios have lower standard deviation of return, which you hate, and then you just avoid risk and still achieve better return. Isn't it more efficient, right? Compared to 100% invested in LG Chem. Achieve efficiency by going this direction, right? And every part of this frontier over here, okay, it's much more efficient than the other parts of this portfolio, okay? Now, that's only 3 stocks case. How about expanding into all the stocks in the market? Yeah, thousands of different stocks. Then you will be able to form like umbrella-shaped area like this, and the part or the point over here is called minimum variance portfolio or minimum standard deviation, minimum variance portfolio. Based on your risky assets, okay? And then from here all the way up over here, this curve is called efficient frontier, based on all risky securities. Frontier because, you know, it's the maximum that you can achieve, right? Maximum expected return based on all risky assets. Now, we introduce different kind of asset. Okay. Up until now, we were talked about risky asset in the stock market or oil market, whatever commodities, right? All risky asset. There's one unique kind of asset which is risk-free. That is your government treasury market, right? Your government bond. So, by definition, those government bonds is risk-free, which means your standard deviation of return has to be 0 over here. And then your expected return should be there as well, right? Yield to maturity, if you hold on to this one until the maturity. Now, if you introduce risk-free asset, what happens? Your possible portfolio can include this one and this one. Someone over in the efficient frontier, you can think about straight line. A straight line that goes through this risk-free portfolio and then risk-free asset and be tangent upon this efficient frontier. And this point, the tangent point, is called market portfolio or efficient portfolio. And this yellow line, we call it capital market line or CML. And later you will refresh your memories about security market line. Spellings are similar, awfully confusing, and frequently asked in your exam, right? Capital market line is about all these risky assets and risk